Thanks so much for tuning into this earnings interaction with the management of Happiest Minds. It's that one mid-sized company that keeps on having investors wanting a slice of their pie because their growth has largely been consistent. The question, though, to both our guests, to Venkatraman Narayanan and Joseph Anantharaju, is that whether Q3 was a bit softer than what they would have penciled in, or was this in line with what their estimates are? Are they sticking to the earlier guidance of the growth of 20 to 25%? I think they usually refer to 20%. I bring in 25% every single conversation simply because of the past performance. And how are the challenges around the hiring metrics as well as attrition? Gentlemen, both of you, thanks so much for joining in. And of course, I hope all is safe. But let me start off with the basic revenue growth numbers. In any normal quarter, 5.5% or thereabouts is pretty strong. When I compare it to what some of your peers have managed to do in Q3, it seems that you were maybe slightly off the boil. Is that a correct analysis? And was there something that went behind it? Or is this something that you believe you had chopped out? And is this something that meets your expectations?
Anyway, Neeraj, thank you when you said peers, because if I classify the market as mid-cap and the large cap, we are almost number one when it comes to the mid-cap guys on a year-over-year basis.
Of course.
With the large cap guys, yes, some of them have shown a quarter-over-quarter growth, which has been surprising, which is also got to do with what their Q2 base was. We have been rather consistent, if you have seen over the last 3 quarters or 4 quarters, and we've been showing the 5.5% number. And the expectation is to continue that trend. Obviously, December is sort of a soft quarter. Joseph can add to it from given the holiday season and some of the roll-offs that happen, because the new budgets starting January for most of the customers. So there is a little bit of a realignment that happens, and that could have had an impact. And being a smaller company with a smaller base, it starts to show up a little. Larger companies have got the basis or the benefit of the rollover, as you say, going quarter to quarter. But the fundamental growth that we are showing, 47.3% in rupee terms, 9-month over 9-month, is really stellar. And that comes with profitability growth as well. Profitability growth followed by cash growth as well.
Yeah, no, I'll get to that. But Joseph, since you had to bring in, what I meant was actually Q on Q. Sequentially, for companies which are not in the Nifty, but the non-Nifty companies,
right,
some of them have actually shown fairly high quarter-on-quarter growth, and some of them haven't. So, which is why my point. I mean, is this something that met your expectations, or would you have bargained for more had it not been for furloughs and holidays both in India and the US?
I think you make a good point, Neeraj. You know, the holidays typically for companies like ours, where we work more as partners with our customers rather than work on programs and on fixed price projects where it doesn't impact you as much having holidays. It has a little bit more impact, and that's what we had expected. Would we have liked more growth? Anytime more growth is always something that you would want. But this is in line with what we anticipated, given the other factor was people hadn't taken much vacation because of COVID. And we saw people getting a little bit more, family time, and which is also, I think, good, because there's so much of stress that's built into people. And this is one time when there's not as much customer stress. So it's good for people to recharge a little bit. But overall, I would say it was in line with what we expected, given the circumstances around holidays and people taking vacation and things like that.
Okay, a couple of questions on the revenue front, top line of both Venkat and Joseph, and then we'll of course move on to the margins and the attrition and the bottom line numbers. But just on the revenue front, when I looked at verticals, high tech, really good, and it's been good for a couple of other peers of your size or slightly larger or slightly smaller as well. So that vertical seems to be doing good for most. What went behind it? And when do services start getting the bigger traction, if you will?
So I think if you look at high tech, there were 3 very strong logo wins that ramped up very quickly. A couple of them were in the security space. One, both having cybersecurity and IDAM platforms. So servicing the with more focus on cybersecurity, but providing a broader suite of security services. And a third was a company that provides analytics and AI capabilities for customers who are on more of legacy platforms. So they have a platform that sits on top of it. And all three of these customers ramped up well. I must say that, if you look at our fact sheet again, security as a percentage of our revenue continues to grow very strongly quarter on quarter. And this is a trend that we are seeing. There's a lot of investment. Even if you look at the wins that we've reported, there are at least three wins in the press release itself that talk about managed services around security, and that extends even to the companies that have these platforms. And we've seen at least 3 closures in this year, and all of them, pretty large-sized engineering deals. So that's what has helped on the high-tech front. And we've had a couple of other closures in high-tech, but these 3 have driven that increase in the high-tech numbers, Neeraj.
Venkat, you want to add to it? What about the others, services, and how do you see Q4 as well shaping up in that sense?
Growth across the verticals or the services has been largely secular. If you look at it, except for some bit of reclass that may have happened, all of the sectors have shown absolute growth. So when you look at percentage terms, what could happen is there is a new client which comes in, which is a cybersecurity firm, and then you get a little bit of a reallocation. So the underlying story is growth across sectors, growth across verticals, and maybe even geographies.
Okay. Then about deal wins and logos added, clients added. I believe 11 new clients added with a total of 195 clients as of December 31st. So one, what's the nature of those wins? And rolled into that is my other question. And please correct me if my math is slightly off, but I believe in the con call or in one of the reports that I read, you had mentioned about the number of $1 million accounts and the conversations being very high. And if that number was 31 at the end of Q2, I believe it was 32 as of end of December. Now, a lot of conversations, but the addition of one net addition. Is it because you executed some and then some got added? I just didn't quite get that picture.
So before Joseph starts, I could just give you the math behind the $1 million customer. So you have 2 ways of looking at it. One is run rate based, and the other is trailing 12 months. So basis what the industry has been following, we have been following the quarterly annualized number. So you take the quarter number and then you multiply it by 4 and then you annualize it. If you look at the trailing 12 month, there is no problem. We are actually 31 or 33 customers, which are $1 million customers. If you're looking at annualized, we are at about 32. So the question that was being asked is, are we looking at any drop off in customers? So to which the answer was absolutely not. But are you looking at reduced spend from a particular customer or a customer segment? The answer is absolutely not. It was just that there was a little bit of, I would say, softness in one customer spending in the current quarter, which is obviously going to catch up because these are also budget cycles led. So they hold back some money and then they release it in January. So it was just because of that. And you could see a little bit of a realignment amongst the 10 million, 3 to 5 to 10 million kind of a customer. So my underlying statement was nothing to worry because it does concern the longer term growth aspirations of the company. But the more important number, Neeraj, when you look at the $1 million customers, is the average revenue per customer. So that's gone up to $794,000. It's been picking up quarter over quarter. If the same number last year was 683,000. So what happens is you're adding customers. Are you adding customers which are of decent size? That's the question. Or are you just adding a long tail? So that's where, coupled with a land and expand strategy and a reasonable size of customer, this average revenue per customer is a metric that you have to look hand in hand to the $1 million customers.
Okay. And just to add a couple of more points over here. One is on the $1 million customers, in terms of new addition. Couple of the customers we closed in Q2 and Q3 on a quarterly annualized rate, they already at $1 million. So I think that part we see strong traction there. And again, if you look at the 11 new logos, very nice distribution, 5 in North America, 3 in Europe, 3 in India. and one in rest of the world. So all of the geos are seeing new logo traction. So that's the other thing that I wanted to just draw your quick attention to, Neeraj.
And are you hopeful of these trends strengthening in quarter 4 as new budgets open up, new year opens up for them as well?
Yes, because the pipeline is quite encouraging, and the economic traction that you're seeing and digital traction that you're seeing is cutting across all of these geos. India, I think coming out of the whole COVID and remote working experience, we are really seeing companies, both large and mid-sized, focusing a lot on digital initiatives, and not just looking at maybe having some experience transformation, but they're actually looking at how do you transform your backend as well. So we are, in fact, quite a few of the manufacturing companies that we had engaged with a couple of years back, and they were taking very, I would say, gradual steps. We are seeing much more focus on how to really come up with a digital strategy and implement it along with budgets. So that's an encouraging trend that we are seeing.
Okay. What about the human resource challenges? As is for everybody else, the attrition numbers for you too have picked up on the other side of 20. And I've got mixed responses from companies. Some say that they see this as the peak of the attrition problem. Some, like LTI, for example, says that it's too early to call, even though it looks like the numbers are stabilizing or maybe peaking out, but it's probably too early to call. Where are you on this argument, gentlemen?
So, it's a little bit of a crystal ball out here. But
of course it is. Yeah.
I would,
sorry to put it
I would go with saying that it's too early, but the trends look positive. That things are beginning to stabilize. But again, a lot depends. The NASSCOM had event recently. Not NASSCOM, sorry, one of the banks, where quite a few of the IT companies were present and they were sharing their views. And there's a number of captives that are going to come into India this year is expected to double, and the number of people they'll require is going to expect it to triple, actually, because the existing guys are also going to add more people. So all of these, there's just too many moving parts. But if you're just based on the last couple of months of Q3, I would say that there's reason to be cautiously optimistic, but I think it's still too early to take a view, is what I would say.
Is your take different, Venkat?
Yeah. So Neeraj, that's what I was about to say. Between me and Joseph, we don't seem to have an agreement. Forget about the industry. So during the call, I believe it will take, I think, 2 quarters. It should peak out, as my personal view. Like I said, it's a game of crystal ball glazing right now. That's about it.
Okay, but so could these numbers stay high, Venkat, for you? And is it a big problem, or is it now a manageable problem?
No, it's a problem. But the thing is, we draw comfort from the fact that this is across the industry. So your neighbor is also struggling, so am I. But going by the math of it, there is expectation that the mean reversion is going to happen. So it will pick up to, let's say, 21.1. If you look at the attrition metrics put out by all the companies, they are around 21 higher, 1 or 2 lower than us. In fact, 1 lower than us. So I think it is likely to reverse. So it's a technical kind of analysis that I'm making. Joseph is making a fundamental analysis. The pick is for you to take.
Got it.
The only other point out here that's relevant, Neeraj, is that for us, 96% of our revenues is digital, and people are, I would say all of our people are digital. That 4% also is hardware and other things that contribute towards some of our digital initiatives. So you would say that all our employees are digital enabled or digital trained. Whereas if you look at the other companies, the percentage would vary anywhere from 30 to 50 or 60%, and therefore the attrition in their digital stream, given that the legacy or older business would have a lower rate of attrition, their attrition for just the digital stream would be much higher. Could be at least 5 to 10% higher than what our attrition is if you do a kind of a weighted average calculation.
But that might stay as a problem for a good 2-3 years until the industry catches up, Joseph.
Catches up. understand, but I think our attrition overall, I feel, as Venkat pointed out, in a couple of quarters we should be able to, because there's a lot of things that we are doing internally, and the industry also, as we go through the whole campus batch for this year, and they come on stream, it will have kind of I would say stabilizing effect overall.
Okay. Would you guys look to invert the pyramid, hire a lot more freshers now compared to laterals in that sense?
That's something that we've been doing. So what we did this year is, all along we've been doing more of hiring from finishing schools, because that way, if you just look at the digital landscape, there are so many technologies, right? And rather than getting in people and figuring out, last year there was not as much visibility to get the campus batch last year, because we would have had to do the hiring in 2020. So we've been going to finishing schools and making sure that we're able to get the kind of skills that you want, whether it's front end, Salesforce, analytics, whatever it is. And that number has been, I would say, as a percentage term input over the last 3-4 years, if you did a calculation, the fresher input or 0 to 1 year input from training schools and other areas would be double of what we had earlier. And this year we've gone to campuses, expect them to join, in June, July, August timeframe. We've got a good program in place to onboard them. So a lot of work and effort going in that direction.
Okay. So Venkat, two quick questions. Where do you expect EBIT margins to stabilize? Part one. And part two, is the DSO days moving up something that you're trying to manage and it's becoming difficult, or do you reckon that this was seasonal and it'll come off?
First, I'll cover the margin part. I've been saying that we'll tend towards 22 to 24%, like the revenue growth of 20%, which you nicely took it up to 25%. I've been talking about 22 to 24% as far as margins, EBITDA margins are concerned. Another quarter behind us, we are still 25% plus, 26.1% to be exact. I'm still holding to 22 to 24% because I don't want to be seen as not making investments when required. When there is a reversion of people coming back to work, I'm likely to see an increase in costs. Right now, maybe some bit of the cost increases, the compensation cost increases is being made up through foreign currency fluctuations, which are in our favor right now. So a lot of levers playing the plus and minus out here, Neeraj.
Yeah, which is what I was asking, that maybe it's...
Oh, yeah, it was, that's what I said. Eyes off the ball, honest answer to a difficult question.
No. my job to do that, because you guys are so much valued. Yeah.
And a little bit of the December effect also, right? Neeraj, because your customers go on vacation. And again, the other thing we've seen this year is, unlike maybe 2018 or 2019, and even 2020 for that matter, we saw customers also taking a little bit earlier time off. By mid-December, they took time off. So, and some of them have got impacted here as well. So their, accounts payable departments and finance departments also were not functioning at the level as it is traditionally. Collection is a little slow in December, and they got a little bit more impacted. But as Venkat said, sales, all of us are back, on this, and we are seeing numbers moving in the right direction.
Final question, gentlemen. So Piyush Goyal in that recent event mentioned that exports could be $1 trillion. IT industries could lead the way. IT industry will lead the way. You're talking about stable margins being at 22 to 24% from 26. It will not happen unless you use that margin lever to invest into growth. Why are you telling me you will do only 20%? And for how long will you continue to do this 20% if indeed the industry could reach as much as $1 trillion in this decade?
This answer, we did answer this in the call.
I was not on the call.
No, I know. So I'm going to borrow from what Ashok, Joseph, all of us had to chime in. This year we are showing about 47% growth right now, and hopefully we'll maintain this kind of a number for the year. Next year, again, it could be a high double-digit number, keeping your fingers crossed, and we can see it. We have been talking about 20% organic growth on a sustainable, meaningful basis for the next 5 years. and add to that inorganic growth. So 20% on 5 years basis is a big number, Neeraj. It's a huge number. So yeah, but the problem is the task at hand becomes a little bit easier because I've just covered 47 right now, and then it becomes 35. So there has to be a reset at some point in time. Agree with you. We'll come back to you with a reset after looking at how the next 2-3 quarters are playing out. But the point is very well taken. I can't keep saying 20% organic growth if the base is shifting so much like the way it is, and there is explosion in demand happening around us. Second thing is obviously inorganic growth will add to that. And if you look at the new vision that we have set for ourselves 2031 and forward, we have said that we want to be $1 billion company in 10 years. So if you do the math of 20% growth, it's not going to add up to $1 billion. The best we will touch is something around 630. So there is an element of inorganic play. There is an element of making that acquired business also grow at the 20% number. Challenges are many, Neeraj, because what we do in Excel and put out something is something that we need to execute on.